on with the mentality of states where they come in and they want to tax people where they're already getting paid taxes. They don't need to double it up and triple it up on individuals. And so that becomes a problem, especially when you want to protect your assets. And in California, I'm going to hit on that. Let me just show you what happens. If you want a limited liability company in California to hold a rental property, it doesn't, and you set it up as a disregarded entity, so there isn't a federal tax return you have to file. It all passes right to you. You pay taxes on your 1040. You pay taxes in California on your state income tax return on all the income you generated in that LLC, but that's not enough. Because you have an LLC, they're going to charge you a minimum of $800. And the tax is on gross income. So if you have a limited liability company, let's say you're flipping real estate in California and you flip one house and you make $1,001 on the flip of that house, profit wise, I mean, it sounds like a lot of money, but your profit is only $75,000. Well, then they're going to tax you on that gross income and you're going to pay $6,000 for the privilege of flipping that property in an LLC. And that's going to flow down to you as well. And you're going to pay tax at the individual level. So that's been a problem for individuals. Corporations in California, for instance, they pay tax on the net income. A C corporation is taxed at 8.84%. So many states have something similar to this. S corporations are taxed at 1.5%. Limited partnerships, that's another entity that people will use. In California, if it's disregarded, it doesn't have to pay tax, but otherwise it will pay tax, and that it pays a flat tax of $800. So these fees become problems. And so what you should be doing, of course, when it comes to an asset protection structure, this would be the approach I would take and what I advocate and what I'll be teaching at the summit, is you should be taking